Yes, so I am recording that in the course financial reporting, there is a topic that is very important, which is financial analysis or financial ratios and analysis. So it's very important that you are very conversant with that conversation. So now, in the previous class that we had time to just basically, look at the ratios themselves, interpreting them, what they really mean and what they communicate to us. We also did time to look at the different formulas, for the same ratios and how they are actually computed. But as of today, I want us to look at an example. I want us to look at a question. When we look at the question, I think that will help you understand properly how the financial statements are handled. And so what we want to do now is to go ahead and read the question. Confirm you can see the screen and can hear me clearly.
Yes, sir.
Oh, thank you very much. So the following information has been extracted by, the company, and it's about the published accounts of this particular company. They've extracted a profit and loss statement. And then they also have extracted the statement of financial position, the balance sheet, right? They have extracted the balance sheet here. So we have the PL, profit and loss on top. And afterwards, they have also extracted the balance sheet. Basically, this is the statement of financial position. And they have given us the data for 2 years, yeah? 2000 and simple 18 and also 2019. And this is what we actually do have. So what is required of us doing is to do the following. It is to do the ratios, yeah? We are supposed to do the ratios. And so the following are some of the ratios that we are supposed to do writing on the very question. Let me just show you the ratios. The ratios that you are expected of doing, you are supposed to compute the ratios, calculate the comparable ratios in two decimal places of the same. So we are basically supposed to do these ratios. Yeah, for the year 2019, we have these ratios for the year 2018, and we have the ratios for the industry, but we don't have the ratios for 2019. So we want to do corresponding ratios for the year 2019. Yeah, so in short, we'll need to come up with the return on capital employed for 2019 using 2019 data. We will also have to come up with the profit margin, the asset turnover, current ratio, quick ratio, the gross profit margin, and also the accounts receivables collection period, the accounts payables payment period, and the inventory turnover times, and conclude with the gearing ratio. So then what we are going to be doing, remember, I said that when you're analyzing the financial statements, it's a ratio, just one ratio. It is non-intuitive, right? It doesn't make any sense unless the ratio is either compared, with the ratio of the other company. So, and do something that we call company to company analysis. Then you could also have the data for the industry. As you have already seen, we have the results for the industry, where we want to now to compare the ratios that we're going to calculate with the industry ratios or with the industry average. So we want to check the performance of our company, comparing it to the performance of the industry, basically. That's what you're doing. So remember, in this question, we're going to be doing, since we have the data for 2019 and for 2018, we're going to be doing year-to-year analysis, which is period-to-period analysis. And then we also have the company data for the year and also for the industry. So also be comparing the performance of the company with the performance of the industry at the same time. So that is what we are going to be doing. So it is actually 2 in 1. Okay. So after we have done the ratios, the question says we need to go ahead and also come up with the report. We need to write a report to the board of directors, and we analyze the performance of the company, comparing it against the previous year, that is 2018, and also against the industry. So we are writing a report. You write a report to these to the board of directors. So first of all, you do the ratios for 2019, then you compare with the previous year and also with the industry and report to the board of directors. So that's what we are going to be doing. So first of all, we need to come up with these ratios. We are starting with the return on capital employed. The return on capital employed for 2019. How do you do return on capital employed? What is the formula for you to come up with the return on a capital employed? How is it done? Return on capital employed. We don't remember the return on capital employed, how it is found, no? Okay.
I can try.
Yes, you can go ahead.
The operating profit divided by the capital employed by 100.
Yes, thank you very much. So it is the operating profit, right? Yeah. It is the operating profit. Now remember, the operating profit, this is the message that we want to send. The operating profit, it is the profit before interest and tax, right? That's the operating profit, isn't it? Operating profit is profit before interest and tax divided by the capital of our company. So now, in this question for 2019, we are given the net profit before tax, all right? We are given the one before tax, meaning before they deducted tax, and then afterwards, it means that they had already charged, all right? They had already charged for depreciation. That's what the question says. They had also deducted the interest. Have you seen that? They had also deducted the interest of 80. But since the profit before interest and tax, it means you have not yet deducted the interest, isn't it? So it is just right for us to conclude that we have to add back the interest. You're following, right? Add back the interest to the net profit before tax so that it can become PBIT. You get what I said, eh? PBIT is the profit, profit before tax plus the interest, and divided by capital. And profit before tax is 465. That to be divided by, plus the 80, the interest, divided by the capital. And how much is the capital of the company? How do you find the capital? How do you find capital? Huh? How do you find capital now?
I think you're going to add the equity part for the balance sheet.
Mm-hmm. And what? All right. Okay, listen. You can, for the capital, remember capital is made up of equity plus debt, right? So you can either add the equity section of the balance sheet plus the non-current liabilities. You get what I mean, eh? Plus the non-current liabilities. So you can add the equity section plus the non-current liabilities for 2019. Okay, or alternatively, the alternative way of doing it, you can say total assets minus the current liabilities. Is that clear? Because we do know that from an accounting equation, total assets is equal to capital plus liabilities, isn't it? So from that, we know that to find capital, we can still less, from total assets, the current liabilities, then we will have total capital. Are we good? So it's that simple. We can just have total assets, and our total assets for 2019 is 38, yeah? 3,800 minus the current liabilities are given us 890 for 2019. What is the difference? What is the difference?
2910.
2,
2910.
2910. Yes.
That's the
Okay. So that's the denominator, 2910. What about the numerator when you add 465 plus 80? What do you find?
545.
545.
45.
545.
Thank you. So times 100, of course. So what percentage is this? Alternatively, for capital, you can add this equity section plus the non-current liabilities. They should give you the same thing. You've seen, eh? It's the same thing. You say 2110 plus the 800, then it will still give you the same. That's the message we are sending. What is the ROCE? Return on capital employed.
10.7.
18.73.
18.73%. Okay. 18.73%. Now, if you want to compare this one, the 18.73% return to this one for the industry, you've seen, eh? Let's start from 2018. You've seen the one for 2018, eh? The one for 2018 is 16.30, which means that the return on capital employed for 2018 is higher than the one for 2018, eh? Oh, the one for 2019 is higher than the one for 2018, isn't it? And it is also slightly higher than the one for the industry, because for the industry is 18.50. Is that clear? I'll be doing the comparisons at the same time, so that when you are
That's us doing class.
verify the network, but I am back now. So that's what Mhm. Yeah, the network is really becoming bad. Let's try one more time and see. Let's just try one more time and see if it can really do better. Yeah, but otherwise, I don't know. Okay. Are we still connected? Can you see the screen now?
Yes.
Oh, okay. Thank you. So let's see. Let's continue. So we have the next ratio, and the second ratio is actually the profit, against sales. Profit over sales. This is the profit to sales ratio. And so we just need the profit divided by the sales. Okay. And we do already have the profit, the operating profit. Just divide that by the sales. So let's have it. Let's get back here. You see, we are just doing 2019 ratios. So the profits we have already calculated. Oh, for 2019, the profits before interest and tax 465 plus the interest of 80, and all that divided by the sales 11,200, right? 11,200 so times 100, of course. So what is the rate as profit to sales ratio? Operating profit.
4.87.
4.87. Thank you. 4.87%. So when we compare this now, we can compare this to the industry and also to the, what is this? To 2018. 2018, it was 3.9, right? It was 3.9. Definitely, we are doing better in 2019. In the previous year, it was 4.73. We are slightly doing better again. All right. We are slightly doing better again. Okay. So generally, in terms of profitability, if you have observed using these two ratios, we are doing better than the previous year and also than the industry. Okay. Then let's come to asset turnover. Asset turnover. Okay. So this one is just basically the assets themselves, and are divided by what? What did we say assets are divided with to find the assets turnover? The assets turnover. Okay. So it's basically finding the assets, find the assets, and then the assets to be divided by by the sales. So it is sales that we have divided by the total asset, and by asset turnover, or this is basically, remember I said that the asset turnover can still be sales divided by capital employed, right? The capital employed is still the same using the three compositions. So you can use capital employed. Yeah, basically, and you do your math We had already found the capital employed. Asset turnover is 11.2, or the asset, what's this? The sales for 2019 is 11.2 divided by, capital employed 29.10 that you had found. And then you should be able to find the asset turnover. So by asset turnover, we are just basically talking about the total capital employed that should be enter into the sales. And what do you find?
$3.85.
3.85. So what this does times, so you put X, or if you don't want to put X, you can say 3.85, you can write in words like this, times, right? So, which means that the assets are being generated to make sales 3.85 times, which is at least better, yeah? That's faster. We need our assets. So it's a question of how useful are our assets in generating the sales. Okay. Then the next ratio is what? Oh, we compare it first. We have to compare with the previous year. Our previous year was 4.9. 2018 was 4.19. 4.19. And the average is what? 3.91. So we are doing, we are below the performance that we had last year. Last year was better than the year we have now, than 2019, isn't it? It's because that one was 4.19. This is free, and again the industry was 3.91. So the industry and also for 2018 performed better than us. So that's the conclusion. So in general, these three have helped us to really look at the snapshot of the profitability, their profitability ratios, and you can see that so far from the ratios that we have looked at, generally 2019 we are performing better. Let's look at the current ratio. How do we do the current ratio? The current ratio, we said, is found by doing what? It is found by doing
Current assets divided by current liabilities.
yes, current assets divided by current liabilities. So you need to do current assets, and the current assets are how much according to the question that we have? All these are current assets. This value is for current assets, isn't it? 1950, right?
Yes.
To be divided by current liabilities. And for current liabilities, I think we need to scroll again.
890.
It's 890. Someone has a question on how we are finding this position. You know that for current assets, you just add these, then their total is this one in this column. So basically that's what. So when you do all that, what do you get?
2.19.
2.19. 2.19. Let's have it 2.19. All right, to 1. 2.19 to 1. That is for 2019. Let's compare it to what we had in the other year, 2018. 2018, they had the 2.14 to 1, right? So it is slightly above, yeah? Actually, it's even better than the industry, isn't it? The industry is 1.9, but is it above? Yes, it is above. This is 2.19. This was 2.14 for last year, 2018. And the industry was is just 1.90. So we are doing better than the industry in terms of having liquidity, and also we are doing better than last year. So this simply means that this year, 2019, we have more of current assets that can sponsor the current liabilities more than last year. So we have more current assets that can sponsor liability more than last year. Is that clear? We can get to the quick ratio. Let's do the quick ratio, you see. See now with the quick ratio. How do we do the quick ratio? What's the formula?
Current assets less inventory divided by current
Current
liability.
asset less inventory divided by current liabilities. So from the current assets that we had already, 1,950, we have to less the inventory. The value of inventory, which is 400 and what? Or 640. 640 less closing inventory divided by current liabilities. And current liabilities equal to what? 890. 890. So what do we find? What is it that we find?
1.47.
Thank you. 1.47. 1.47. All right. That is in 2019. But last year, it was what? 2018. 1.52, right? It was 1.52. The industry is 1.27. What does that mean? It means we are still doing better in terms of liquidity, isn't it? Are we doing better? Oh, no. We're not doing better than than last year, yeah? Last year was 1.52. This is 1.47. But we are doing better than the industry, right? We are still doing better than the industry. So that's the understanding. Okay, so we are still okay. We are doing better than the average. Then there is a gross profit margin here. That's the next ratio. And how do we do the gross profit margin? Gross profit margin, how do you do it?
It gets gross profit over sales or cost of sales.
Yes. Gross profit over sales. Now, for you to find the gross profit, how do we find the gross profit? Because we don't have gross profit in this question. It is basically sales minus cost of what? Cost of sales, isn't it? Divided by the sales themselves, multiplied by 100, yeah? Sales, 11,2. Cost of sales, 8,460, right? 8,460 divided by 11, 2 times 100. This is what gives you the gross profit. Because the gross profit is basically sales minus the cost of sales. That should give you the gross profit. What do we find?
For the gross profit, are we finding the value or the
Or in terms of percent, I thought we'd leave it at the value so that we just divide by the
We
sales.
we're expressing a oh yeah, I want the gross profit margin. Like we
As a
want the margin.
percentage.
The margin is multiplied
Oh, the
by 100.
margin.
Yes, that's what the question is looking. So find the gross profit over the sales. And what is it that we find?
It's 24.46.
24.46%. All right, 24.46%. That's the gross profit. It is also one of the ratios we use to measure profitability. So, which means that we are doing, how is it now? This is worse than the industry and than last year in terms of the gross profit margin. Okay, we'll give the report. Don't worry, we'll hear how the report is coming out. Yeah, let's do the accounts receivable collection period. The receivables collection period. How do you do this one? Receivables collection period. This one is what? Receivables divided by what? By sales by 365 days, right? Our receivables for 2019 is 1230 divided by our sales, right? Our sales, our sales, 11.2, yeah? Multiplied by 365. How many days are these? How many days does it? 40 days. 1 month, 10 days. Okay. 40 days. Let's compare with the industry. So this is a question of how long does it take our, our customers? There are those that we sold to on credit. The question is, how long does it take before they can settle their, how long does it take them to settle their accounts? Okay. It is 40 days. And also in 2018, it was taking them 40 days. You've seen, right? But the industry is taking 52 days, which means that we are slightly better. Yeah? We are better than the industry, because ideally we want few days, isn't it? The people should be able to give you back your money, within the shortest possible period of time. You don't need so many days for the people who are owing you to settle their accounts. So since they are able to settle their accounts as early as possible, please, this is a plus to us. So we have not really improved better than last year, but we are doing better than the industry, than the average. Understand, right? We have maintained. Is that clear?
Yes, sir.
Debt collection period or accounts receivables collection period. We go on to payables. The payables payment period. This one is basically payables divided by cost of sales. All right? Cost of sales multiplied by 365 days. All right? So the payables, our payables, 750 divided by the cost of sales. We find the cost of sales from the profit and loss statement. It was 84 60 times 365 days. How many days does it take us this year to settle our balances to our creditors or the suppliers that supply to us on credit? How long is it taking us? Let me just, okay, you said it's 250? How many days are these?
32 days.
32 days. 32 days. 32 days. But when you look at the 32 days, last year we were taking 37 days, eh? And we are taking 32 days. We pay early. The industry, on average, people take 49 days. We are doing better than the industry, right? We pay earlier than, not really we are doing better. We pay earlier than the industry, and we are also paying earlier than last year. We are settling that. But as a question of, is this really better, or is this really good or bad? What does the class think? Do you think it's a good thing to pay the people you owe earlier their money? Or you should keep the money so that you can use it to do other things? What do you think?
It's a good thing that we are paying them earlier. But when if you have to compare with the receivables, we're taking more time to get the money that is owed to us than we are settling our debt.
Our debts.
Yes, which can affect us, I think, in my opinion.
Yeah, thank you very much. Yeah, as we delay getting our money from people who are owing us, but as we are paying, our relationship with our suppliers, right? They will be happy. They will keep on supplying to us on credit. But I think we have to work on the collection of our receivables from our debtors so that it can be faster, because there is no way how this can be delaying. It was going to be better if our people were paying earlier than the way how we pay if possible. But it's a good thing, morally right for us to pay, the money on time. Okay, that's a good one. Let's go to, which one is which now? The inventory turnover times. Inventory turnover is cost of sales divided by inventory. All right, they have said turnover. If they had said the inventory days, you could have flipped the equation and said the inventory over cost of sales times 365 days. But they have asked for inventory or turnover times. So you flip the equation like that. So cost of sales for the cost of sales for 2019. We already have it. It is the 8460 divided by the inventory. Inventory is the 640. Just that. So how many times are those? So it's a question of how long does it take for us to convert the inventory? How fast do we convert the inventories compared to last year and the industry? How many times?
18.22.
18
13.
or 13 or 13.22. 13.22 times. As for now, we are not yet certain whether we are doing better or worse. Let's check what the industry is doing. Last year, we had the 13.9, right? This is 13.22. The industry is what? Is it 18? Am I seeing 18? More.
18.
The industry is even 18.3 times. So the industry is faster on average. The industry is faster than us in converting our inventories into cash. We are even doing worse than last year. Last year we're slightly better, than this year. So we need to improve on how fast we can convert the inventories into cash. Practically speaking, here, what do you think can be done? Like from your own analysis, what do you think can be done to have us, manage to, yes, what can be done for us to manage to increase the number, the speed at which we convert inventories? What do you think would be affecting this company, really? Just from your own way of understanding, eh?
Maybe their credit facilities are not so well, so people not really go for their products or something, and they end up keeping inventory more.
Yeah. Maybe they are expensive, huh? Maybe the prices are high or whatever. Anyway, we can only speculate, but we don't really have additional information. You will see then in the next questions that we are going to do, there will be additional information that will help us not really to speculate. They will help us to, to know exactly what they could have, tried. Now let's go to the gearing ratio. Remember with the gearing is basically debt over what? Is debt over what? Over capital, isn't it? Gearing is debt over capital. We want to see in our capital how much is debt. So as for 2019, the debt is this one, non-current, liabilities. It was 800 to be divided by capital employed. We already calculated it as 2910. You remember? Times the 100. So what is the degree of gearing? The level at which we use, the non-current, the level at which we use the liabilities.
Sorry, sir, I lost you on the gearing aspect. Please come again.
Oh, so on gearing, we said this one measures how much of debt do we have in our capital structure? Like in our capital, how much debt do we have? So it's basically debt over capital. So adding more debt to the capital structure is called gearing. So when a firm has more debt than in their capital structure, we said it's highly geared. But if it has got less, debt, we said it's low geared. And if debt is equal to equity, then it is neutrally geared. Okay. So what's the gearing ratio?
On 7.49%.
Sorry?
27.49.
27.49%. All right. Let's check what we have in the industry. The industry is 32. That's the level of debt. It's higher even than us. Even last year was lower than, yeah. Anyway, this year we have slightly more debt than last year. You get it, right? This year we slightly have more debt than last year. Then the industry actually, but we are still doing better than the industry. The industry has, on average, people have more debt in their capital structure than us. You get the point, eh? So that's what is done. So now, on a part where we need to make a report, eh? That part where we need to make a report to the directors. So there is nothing much we're going to be doing to the director. You just say, for example, when you write profit, let's say profitability, you are reporting profitability. You will just report these ratios that talk about profitability. These, like, it's a report. Did they increase or maybe they reduced? Are we doing better? Or that's what you write. And again, you go on to liquidity. Under liquidity, you just comment on current ratio and the quick ratio. Did we improve or we are doing worse than whatever? So you factor in the additional information if at all you have any additional information in your writing. Right? Sometimes you may have additional information. So you need to factor in the additional information. Okay. So you go on like that. This one is, these are efficiency ratios, the accounts receivable. So you are interpreting each ratio basically. Oh, this year our customers are delaying to pay us, the same way how we were writing. That's how you write the report. Is that clear? But I'm interested in the title, the way, see how the sample was done when on the reporting to the director. I've seen the way how the report is done. So you write to the board of directors from accountant date, you write the date, eh? Subject, analysis of performance of the company. And then you write, you say this report should be, it should be read in conjunction with appendix so-so. You understand? This appendix so-so is the one that has the calculations that you are doing, eh? The workings. Remember, you computed those ratios, right? The ratios should be attached down. Don't bring ratios first when you are giving a report to the board of directors. The ratios, they go down as an appendix. You write, you just bring the words. You write, interpret. The interpretation is what we are interested in. So that if one of the people reading is interested in getting the details, they can go down to the appendix and they'll find those ratios calculated. Is that clear? For example, let me show you, let me just read what was reported under profitability. You know, they said that the return on capital employed, has improved considerably between 2018 and 2019 and is now higher than the industry. Exactly what we were talking about. And then the net income as a percentage of sales, all right, has improved noticeably between the 2 years. And it is actually also ahead of the average industry. The gross margin, however, is lower than the previous year. Yeah. And it is also, compared to the industry, just like that. So you just pick the ratios, speak about them, pick the ratio, comment on the ratio, just like that. And then when it comes to the what is this? To the liquidity, they report the current ratio. The current ratio has improved slightly over the year and is marginally higher than the industry, just like that. So there is nothing much that you write, and that's how you write the report to the board of directors after analyzing. Okay.